No, thanks a lot for that generous introduction. It's certainly a great honor to return to the Economic Club of Minnesota as a guest speaker. I spoke here a couple of years ago, and I'm delighted to be able to close out your 2011-2012 season, a season that began so auspiciously by Federal Reserve Chairman Ben Bernanke. I think all of us here today and all of those across the state who come together for these events during the year benefit from the work that you do at the Minneapolis Club, the Economic Club. So my deepest thanks to you for all those efforts and for inviting me here today. So I became president of the Federal Reserve Bank of Minneapolis in October of 2009. One of my main objectives since then has been to make both the Minneapolis Fed and the Federal Reserve System more open and more transparent. And I've been delighted to learn that I'm not at all alone in this pursuit of greater openness. I see many positive developments along these lines throughout the system, and especially on the part of the Federal Open Market Committee. The FOMC, as David just mentioned, is a monetary policy making arm of the Federal Reserve. It meets every 6 to 7 weeks to chart the course of monetary policy. And the members of the Board of Governors, there's supposed to be 7, right now there are 5, and the presidents of the 12 regional feds, including myself, take part in these meetings. Today I'll talk about a significant improvement in the FOMC's communication about monetary policy. So in January 2012, the FOMC released a consensus statement describing its long-run framework. So Congress has given the Federal Reserve a dual mandate to promote maximum employment and to promote price stability using monetary policy. The January framework statement is important because it outlines a strategy that the committee uses, that it follows in order to implement the FOMC's dual mandate. As you will hear, the framework statement provides a quantitative definition for price stability through a numerical target for inflation. But it does not do so for unemployment, for maximum employment. I will spend a considerable amount of time discussing this latter aspect of the statement, that it does not provide a quantitative measure of maximum employment and its relevance for current policy. Before proceeding, I'll remind you that my remarks reflect my own thoughts and not necessarily those of others in the Federal Reserve System, including my colleagues on the Federal Open Markets Committee. So let me start with some context, some historical context. Over the past 30 years, central banks all over the world have become much more transparent about their objectives and how their current actions allow them to achieve those objectives. This transparency is widely viewed by policymakers and by scholars as an important means of enhancing the effectiveness of monetary policy. So most central banks around the world aim to keep medium-term inflation low and stable at around 2% annually. And they've been quite successful in achieving that goal over the past 20 or 25 years. And they view that success as being due in part to their communicating on an ongoing basis how their current policy actions are consistent with that 2% goal. There are at least 2 benefits of this kind of transparency. I think the first is broadly appreciated. By being clear about their objectives, central banks are better able to achieve those objectives. So here's what I mean by that. For example, if the central bank's announced inflation target, is 2% per year, firms and employees in the economy know that wages need to grow by 2% to keep up with the cost of living. And that knowledge helps keep wages from growing so fast that firms will have to raise prices by more than 2% to cover their increases in their labor costs. That, in turn, contributes to keeping inflation under control. So transparency about objectives helps anchor inflation expectations. The second benefit of transparency is less appreciated, but I think it's no less important. A transparent central bank is more accountable to the public because it is forced to be more disciplined in ensuring that its policy actions are in fact consistent with its objectives. The central bank knows that the public will be able to track its performance. When performance matches words, the public will have an even stronger belief in the central bank And that, again, serves to anchor inflation expectations even more solidly. So these considerations have given rise to a trend towards central bank transparency internationally. What about here in the United States? So I think we can all take pride in the fact that under Chairman Bernanke and under his predecessor, Chairman Greenspan, the Fed has made enormous strides in transparency. It's easy to forget that as recently as 1993, not even 20 years ago, the FOMC would act and not tell anyone for 90 days. It was not until 2000 that the FOMC began issuing the statement that many of us now take for granted. And it was a decade ago that the roll call of FOMC members was added to the statement. So there's just been substantial progress in monetary policy transparency over the past 15 plus years in the United States. So that's the context of the evolution of transparency around the world and here in the United States. So where do we stand at the beginning of 2011? So at the beginning of last year, the committee had arrived at three main forms of communication about policy. First, immediately after every meeting, the committee issues a carefully worded but brief statement intended to describe the current state of the economy and the current stance of monetary policy. Second, 3 weeks after each meeting, the committee issues a carefully worded set of minutes. These provide a longer but still relatively high-level description of interactions within the meeting. Third, after the January, April, June, and October/November meetings, so the second to last meeting of the year takes place either in October or November. After these four meetings, the FOMC releases a summary of economic projections. Among other things, these quarterly releases contain information about FOMC meeting participants' goals for medium-run inflation and unemployment. And here by medium run, I mean where FOMC meeting participants see inflation and unemployment converging over the next 5 to 6 years under appropriate monetary policy. Now, with that 2011 backdrop of where we stood in January 2011, there have been several changes in FOMC communications over the past year. Two of these are the introduction to regular press conferences by the chairman, beginning in April of 2011. We've had 5 of those. I think they've been very successful. And the regular release of FOMC participants' individual assessments of the appropriate path of short-term interest rates. So that began in January of this year, that the summary of economic projections I've already referred to now contains information about where FOMC participants see appropriate monetary policy evolving over time. So those are 2 changes that have taken place. I'm not going to spend any more time talking about those. If you want to see more about those or read more about those, I gave a speech yesterday actually at the Business Law Institute that's available on our website, and I talk more. You can read more about those changes and the significance of them. I'm going to spend my time today discussing the third change, and so one not coincidentally that I view as the most important. And it's the FOMC's release in January 2012 of a 5-paragraph statement describing its long-run framework. Now, the significance of this statement does not lie in the fact that it represents a change in the committee's approach to policy. What it does represent is a major step forward in the committee's communication of its approach to policy to the public. As I mentioned, there's a statutory dual mandate that the committee is charged with promoting price stability and maximum employment. The statement provides the basic principles of how the committee implements that statutory dual mandate. Now, I'm not going to go through this statement in any detail. Frankly, there's just no need for me to do that. It's short, it's remarkably well worded, and it deliberately, as one who played a small part in crafting it, it deliberately shies away from technical language. And so I encourage all of you here, indeed all Americans, to read it when you have the opportunity. What I will do instead today is to describe 4 aspects of the framework statement that I view as especially important. And the first key aspect of the framework is that it provides a quantitative translation, a specific translation of the term price stability. And it translates it into a 2% target for inflation. And the American public need no longer guess the Federal Reserve's inflation intentions, either on the upside, which gets a lot of attention, but also importantly on the downside. Inflation of 2% is the goal of the Federal Reserve. Second, the framework describes how the committee weighs the two mandates, promoting maximum employment, promoting price stability, against one another. Importantly, it stresses that the two mandates are typically complementary to one another, in the sense that keeping unemployment from rising too high also serves to keep inflation from falling too low, below that 2% target that I mentioned earlier. And I think this point is often underemphasized in popular discussions of monetary policy. The third aspect of the framework that's important is that it enjoyed broad consensus support among meeting participants. And this suggests that any changes, and the committee specifically allowed for the opportunity that the statement could be changed over time, but it does suggest that any changes will require the same level of broad consensus support. In this sense, one can think of the framework as being sort of like a constitution. It is possible to make changes, but it takes a lot of consensus for those changes to take place. So I move quickly through these first three of these key elements of the framework statement: inflation target of 2%, the typical complementarity of the two mandates, and the quasi-constitutionality of the statement. The fourth key feature of the statement is that while it provides a numerical target for inflation, it does not provide a similar explicit quantitative interpretation of the second mandate, maximum employment. I want to spend the rest of my time discussing why it doesn't do so. In part because it's important, and in part, as you'll hear, it has some relevance, special relevance for the policy considerations we face today. I'll start with a quote from the statement itself, the framework statement. This quote says, "The maximum level of employment is largely determined by non-monetary factors that affect the structure and dynamics of the job market." So what are these non-monetary factors? There are many. Population trends, the incentives built into the tax system, the returns to human capital accumulation for young people, incentives built into social insurance safety nets, and simply social norms. All of these non-monetary factors are hard to assess on a real-time basis, and they also change over time. Nonetheless, as the statement goes on to say, the committee's policies decisions must be informed by assessments of the maximum level of employment, recognizing that such assessments are necessarily uncertain and subject to revision. So in what follows, I'm going to spend some time explaining why estimating maximum employment is particularly challenging right now. So I'm going to start by showing you graphs of 4 measures of the recent adverse changes in U.S. labor market performance. And before I show you the graphs, I'll recall for you that economists define the labor force to include all of those over 16 years of age who have a job, that part's clear, or who have looked for a job in the past 4 weeks. And that second group would be the people who are officially classified as unemployed. Okay, so this is the first graph of the 4 I'm going to show you about recent adverse changes in U.S. labor market performance. This is the unemployment rate. It's a fraction of the labor force, of people in the labor force who have looked for a job in the past 4 weeks. What you see if you look at this graph is something that's familiar to all of us, I think, that the unemployment rate rose sharply from 2007 to 2009, and I've shaded that area on the graph because that's the period of the so-called Great Recession. And the unemployment, since that time, the unemployment rose slightly, but it's been falling slowly. So that's the first graph I'll show you is what the unemployment rate's doing. The second graph is what's called the employment population ratio, and this is the fraction of people over the age of 16 who have a job. Now, actually, it's not that, because to eliminate some of the demographic issues that can come up when you think about this question of who has a job, this graph focuses on what are so-called prime age workers, people between the ages of 25 and 54. So it's a fraction of that group in the population who have a job. And what we see here is a sharp decline in this ratio from 2007 to 2009. And in contrast to the unemployment rate, there's been no noticeable recovery in this measure of labor market performance. So the third graph is the what's called the labor force participation rate, again focusing on people ages 25 to 54. And it's a depiction of the fraction of the population in this group who are in the labor force. That is, they either have a job or they have looked for one in the past month. And the interesting aspect of this graph, which is that this fraction has tended downward. It's not a steady trend by any means, but it's tended downward since the late 1990s. If you look at the peak of the graph, it's showing up around 84%, maybe a little bit higher than that, in the latter portion of the 90s. And it's tended downward since then, but certainly that downward path has accelerated since 2008. Okay, so the final graph is the one that is the most inside baseball from the point of view of a macroeconomist, but it's an important one nonetheless. And it depicts the relationship of unfilled job openings, vacancies, and the unemployment rate over time. So the horizontal axis is the unemployment rate, and the vertical axis is the job openings or vacancy rate, which is the ratio of job openings, the sum of people who have a job and job openings. Now, each point in this graph corresponds to a different year. So you take the unemployment rate for the year, take the vacancy rate for the year, and then put a point on this picture according to that. Now, what's going to happen when the economy is doing well? Firms are going to hire more workers, and they're going to find it more challenging to fill their available openings. The unemployment rate is going to be low, and the vacancy rate is going to be high. So when the economy improves, we typically think that we're going to be moving toward the upper left in this picture. When the economy gets worse over time, we typically tend to think we're going to move to the southeast and a down to the right in this picture. And this curve that runs from the northwest to the southeast is called the Beveridge Curve, named after Mr. Beveridge. Now, in the Great Recession and its aftermath, this is why I'm showing this picture to you. You'll see we get this long stretch where we run down down to the lowest point on the right portion of the graph is 2009. We move up in 2010 and move up in 2011. But what we see here is the Beveridge curve has shifted outward toward the upper right. And what does this represent? It means that people who post vacancies are finding it's surprisingly hard to fill vacancies given how many unemployed people there are. Okay, so in that sense, it's harder for the labor market to form mutually beneficial matches between workers and firms. And in this sense, economists say that the labor market is less efficient at forming matches. So we're not just moving up and down a curve that extends from the northwest to the southeast. Instead, we've shifted out in 2011. Okay, so let me summarize what we've seen. Labor markets remain notably worse than prior to the recession. The good news is the unemployment rate has been declining, but there's also countervailing evidence. The labor force participation rate has been falling steadily, and the employment population ratio remains near its low point. And the Beveridge curve shows considerable deterioration in labor market matching efficiency. Now, so that's what's happened. The question for monetary policymakers, and it's an important question for all of us, I think all Americans, is how persistent will these changes in U.S. labor markets prove to be? Economists hold at least two views on this question. The first is guided by patterns in post-World War II data for the United States. And these patterns suggest that the current deterioration in U.S. labor market performance is indeed reversible under appropriate policy. The second view is less sanguine. it says that the post-World War II data do not contain an economic crisis of the kind or magnitude that hit the United States in 2008. And such a crisis could well have a different kind of impact on labor markets than the earlier post-war recessions. Now, this second view is also informed by data from other countries, not just from the United States. So Tim was mentioning that I had given a speech earlier, about a month ago in New Sweden, and now we're going to turn to look at data from Old Sweden. So my staff and I have recently taken a close look at data from Sweden. Now, why do we look at Sweden? In the early 1990s, Sweden was hit by a financial, banking, and currency crisis. What one might call a triple crisis. Now, other industrialized countries, perhaps most notably Japan, have experienced these kinds of crises. My staff and I focused on Sweden because it is generally viewed as having dealt with this triple crisis in a highly effective fashion. For example, in 2007, economists from the OECD wrote that Sweden's economy has made a remarkable recovery from the major crises of the early 1990s, in emphasizing Sweden's rapid productivity growth in the previous 2 decades. So Sweden is held out as an exemplar of how to deal effectively with this kind of triple crisis. Nonetheless, despite the success, the triple crisis had a profound and highly persistent effect on the Swedish labor market. So I'm going to show you the graphs for exactly the same 4 variables that I showed you for the U.S. I'm going to show you for Sweden. And here I've shaded the picture 1991 and 93 in these graphs to indicate the heart of what I call the triple crisis in Sweden. So the first graph depicts the Swedish unemployment rate. From 1980 to 1990, the unemployment rate had never been above 4% and was typically closer to 2%. After 1993, the unemployment rate was never much below 6%. Okay, so the persistent change in the unemployment rate. So the next picture is the employment population ratio, again focusing on people ages 25 to 54. From 1980, to 1990, the employment population ratio grew steadily in Sweden and peaked at over 91%. After 1993, that ratio was a big fall, first of all, from 1990 to 1993. Then after that, it trends upwards slightly, but it remains below 86% for most of this period. I think that it's actually the size of this change over the course of the crisis is best appreciated by thinking about the people who don't have a job, the fraction of people who don't have a job. That went from around 9% in 1990 to 18%. It doubled in 3 years. And this is from a group of prime age workers. But my point, so that's the change in the crisis. My point to you today is that Sweden has not, employment population ratio has not returned to the levels that it saw prior to the crisis, in the decade before the crisis. So next we see the evolution of the fraction of Swedes aged 25 to 54 who are in the labor force. From 1980 to 1990, this fraction rose to a high of about over 92%. After 93, it was typically around 88% and never much above 90%. Finally, we can look at the Beveridge curve. This is more noisy, I have to admit, but again, this is the joint evolution of unfilled job openings and unemployment over time in Sweden. And the Swedish Beveridge curve shifted outward from 1990 to 1995, and that shift has endured at least through 2010. So to sum up, these 4 measures of Swedish labor market performance declined markedly after the triple crisis of the early 90s. And at least up until now, this decline has proved to be permanent. And I should note, too, that these changes happen over a remarkably short span. And one of the other reasons we study Sweden is the Riksbank, the Swedish central bank, has a very comprehensive inflation report where you can actually read what they're thinking about the economy in the course of making their decisions. So in its February 1995 inflation report, the Riksbank suggests that the rate of unemployment that they viewed as sustainable over the long run, their version of maximum employment, what they viewed as sustainable over the long run had risen from 2 to 3% to 6% in less than 5 years. And their assessment, again, this was one made in 1995, has proven to be a remarkably accurate characterization of how Swedish labor markets functioned over the next 15 years. Okay. And this is important to say. There are many institutional differences between Sweden and the United States, especially in terms of their tax systems and their social safety nets. It would be a mistake to conclude from the Swedish data alone that the recent decline in U.S. labor market measures is inevitably a permanent one. But Sweden is not atypical. Cross-country research from Reinhardt and Reinhardt, among others, has found that financial crises tend to be followed by sustained increases in unemployment. Hence, I do think that the Swedish data, and given that they come from a country generally regarded as an exemplar of how to handle a financial crisis, they have to be viewed as informative. At a minimum, Sweden's experience forces us to contemplate the possibility that the erosion in labor market performance that we've seen in the United States over the past 5 years may prove to be highly persistent, even under appropriate monetary policy. So I've been talking through some data. Let me talk about, and now switch to the policy implications of the data. So I've talked about the recent adverse changes in U.S. labor market performance, and I've discussed two sharply different perspectives about those changes. The first is that they're largely reversible under appropriate policy, and the second is that they're likely to be highly persistent. These two distinct perspectives imply that FOMC meeting participants are confronted with an unusually wide range of possible quantitative interpretations of the words maximum employment. These different quantitative interpretations have immediate policy implications. So policymakers who see this deterioration in U.S. labor market performance as reversible using monetary policy will typically favor more accommodative policy than those who view this deterioration as more protracted. So for myself, I continue to pay close attention to the behavior of inflation as being informative about maximum employment. So the term maximum employment in the statutory dual mandate is often interpreted as referring to the level of employment that is sustainable over the longer run without acceleration in inflation. Along those lines, inflation was distinctly higher in 2011 than in 2010 and continues to run above the FOMC's target of 2%. And even core measures of inflation, which strip away energy goods and services and food, went up notably. So again, these are not definitive, but I see these changes as a signal that our country's current labor market performance is much closer to maximum employment than the post-World War II U.S. data alone would suggest. And as I've argued in the past, appropriate monetary policy should be responsive to these kinds of signals. So let me wrap up. I think we should all take great pride in the improvements in FOMC communication that we've seen over the past 15 or so years. There's still more that can be done, of course. My own view is that we need to do more to communicate the economic uncertainties that we face as policymakers and how our policymaking will respond to new information about those uncertainties. So, for example, here I think we can learn much from the practices of other central banks. For example, today's talk, I spent a great deal of time discussing the uncertainties associated with formulating a quantitative measure of maximum employment for the FOMC. An interested Swedish citizen would have been able to read many rich and detailed discussions of exactly this issue in the Swedish Central Bank's monetary policy reports in the mid-1990s. Thanks a lot for listening. I'd be happy to take your questions now on these or any other topic that might occur to you. Thank you.